AI is the future everyone's talking about. Big tech is throwing billions into data centers, Nvidia's stock has gone through the roof, and AI tools are being bolted onto everything from Google Search to Slack. But here's the twist. A brand new MIT study says 95% of AI projects are failing. Meta just froze AI hiring, and even Sam Altman, the guy running OpenAI, admits we're in a bubble. So the question is, are we standing on the edge of a revolution or a crash? The AI gold rush. It feels like we're living through a modern-day gold rush, only instead of gold, it's GPUs in data center racks. In West Texas, an enormous data center complex under construction by OpenAI is part of what analysts estimate may reach $1 trillion in AI-related infrastructure nationwide. Tech giants are pouring capital in at dizzying rates. Microsoft is committing approximately $80 billion to AI infrastructure in 2025 alone, a sharp jump from its $50 billion total capex just last year. Market sentiment is following the money. The so-called Magnificent Seven stocks, Apple, Microsoft, Alphabet, Amazon, Meta, Tesla, and Nvidia, have added trillions in value by weaving AI into their narratives. Notably, Nvidia's stock has surged over 800% since the release of ChatGPT, making it a dominant player in the AI compute race. Even economists are sizing up AI's macro impact. At NYU, Professor Aswat Damodaran estimates that nearly half of this year's US GDP growth could be powered by AI spending, while the S&P 500 rides higher on the wave of AI-driven optimism. On the surface, it looks like a seismic shift. AI is being billed as a transformational force, smartening business workflows, turbocharging innovation, and reshaping the economy with the same narrative power as electricity or the internet. But here's the core question we need to ask. Is this a fundamental transformation, or just raging speculation in a hyped-up market? Cracks in the hype. But beneath the excitement, the cracks are already showing. Earlier this year, a widely cited MIT Sloan study analyzed over 300 enterprise AI projects across 52 companies. The results are brutal. 95% of generative AI pilots failed to reach production. The reasons? Employee resistance, brittle workflows, and poor returns on investment. Most budgets weren't going into cost-saving automation, but into flashy sales and marketing tools that generated little to no measurable impact. That aligns with what investors like Chamath Palihapitiya had observed. The first wave of corporate AI spending was driven less by strategy and more by boardroom FOMO. CEOs were pressured to have an AI plan. Shockingly, over 50% of Gen AI budgets are funneled into flashy new tools for sales and marketing, not back-office automation that actually delivers ROI. The labor market isn't reflecting a boom either. Instead of creating jobs, many AI-heavy firms have been cutting them. According to Bloomberg, tech companies that once hired aggressively are now shrinking, even as they trumpet AI adoption. Over 61,000 tech jobs were eliminated across more than 130 companies through mid-2025, including top names like Microsoft, Google, Amazon, and CrowdStrike. And then there's the promise of productivity itself. AI coding tools, for example, can sometimes double output, but just as often, developers report they're slowed down by buggy outputs and endless debugging loops. Taken together, it's clear. The technology works, but businesses don't yet know how to use it effectively. And when hype collides with disappointing execution, bubbles start to wobble. Lessons from history. If all this feels familiar, that's because it is. We've been here before. In the mid-1990s, the release of the Mosaic browser suddenly made the internet accessible to millions. What followed was a tidal wave of excitement and speculation. Companies with little more than a website were rushing to IPO, often with no profits, sometimes with barely any revenue. Simply slapping .com onto a name could send a stock soaring. Between 1995 and 2000, the NASDAQ index quadrupled, fueled by this frenzy. Then, in early 2000, the bubble burst. Trillions of dollars in market value evaporated, and most of those dot-com startups disappeared. But the internet itself didn't vanish. It matured, consolidated, and reshaped the global economy. Fast forward to today, and the similarities are striking. ChatGPT's release in late 2022 acted as AI's mosaic moment, a sudden mass-market revelation of what the technology could do. Within 2 months, it had 100 million users, the fastest adoption to any consumer app in history. And just like in the 1990s, investors piled in. Only this time it isn't obscure .coms, it's the tech giants themselves. Nvidia has become the poster child, surging more than 800% since the release of ChatGPT. Meanwhile, the Magnificent Seven stocks, Apple, Microsoft, Google, Amazon, Meta, Tesla, and Nvidia, now account for more than 30% of the S&P 500's total value, a level of concentration not seen since the dot-com era. The lesson? Speculation tends to get ahead of fundamentals, and when that gap grows too wide, corrections follow. The sorting phase. Every bubble eventually sorts itself out. The same will happen with AI. A handful of winners will consolidate, while most experiments quietly disappear. But the real story isn't just about which companies survive, it's about what happens to the people caught in the middle. For workers, the AI boom has been a paradox. Instead of fueling hiring, many companies leaning hardest into automation are cutting jobs. A Stanford economist study using ADP payroll data has found that for Americans aged 22 to 25 in AI-sensitive roles, like software development or customer support, employment has dropped between 16 to 20% since late 2022. And this isn't just tech. Ford CEO Jim Farley recently predicted that AI could eventually replace half of white-collar jobs. The MIT study echoed the same tension. Even when AI systems do work, they tend to eliminate repetitive back-office roles rather than create new ones. That's the dark side of the sorting phase. In past booms, overinvestment at least created armies of jobs, laying fiber optics into the 1990s or building social networks in the 2010s. This time, the hype is driving massive capital spending without the same employment payoff. For now, most AI pilots aren't generating big productivity gains, but when they do, the first benefits will be cost savings, which often translates to fewer workers. The winners may be the companies, not the employees. So while Wall Street waits to see which firms survive the shakeout, Main Street is left wondering, when this bubble pops, who really pays the price? The bigger picture. Step back, and the bigger picture comes into focus. Right now, the entire stock market is leaning heavily on AI to justify its gains. The Magnificent Seven alone make up nearly a third of the S&P 500's value, a concentration not seen since the dot-com bubble. If AI spending slows, or if the promised returns don't materialize, the fallout could ripple far beyond Silicon Valley. That's because bubbles aren't just about startups burning venture capital. When the giants stumble, trillions in market cap can vanish overnight. As NYU finance professor Aswat Dadarian points out, a $10 trillion wipeout across a handful of firms could hit retirement funds, consumer spending, and business confidence. And while some argue that overinvestment is simply the cost of progression, the same way we overbuilt railroads, fiber optics, and social networks, the stakes are higher when so much of the market is riding on a single narrative. AI may still change the world, but for investors, the more immediate question is whether today's valuations reflect real productivity, or just another case of Wall Street pricing in a future that may never arrive. So, will the AI bubble pop? The truth is, probably, at least for some companies. History tells us that most won't survive the shakeout. But just like the internet after the dot-com crash, the real innovations will endure, and maybe even define the next trillion-dollar industry. For now, investors are betting big, workers are bracing for change, and the market is walking a tightrope between transformation and speculation. Thanks for watching. If you found this breakdown useful, hit that like button and subscribe. And check out our video on how Shein makes millions from the $5 dresses it sells you.